Okay, welcome everybody to another episode here, 91, I believe. I lose count, but I'm back here in Taiwan. For anybody who doesn't know me, of course, I live about half the year in Dubai, about half the year in Taiwan. I have left the summer heat, so I am back here in my home. I'm actually a tax resident of Dubai. I'm a resident there, but I do like to spend a good 6 months here as well. You know, get the nice tax benefits over there, get the nice living in Taiwan in the cooler months. It's all good, but I did bring some, left some of my gear back in Dubai, brought some of it with me. So make sure you do scream at me in the comments if there's something wrong. Everything looks fine. It's basically just mirrored. I've got the same audio board, same computer, same camera, just, you know, double up on things. But I'm always a little bit nervous when I get to a new location. So let me know if you can hear me okay, and we will get right into things. So it's been a couple weeks, right? I've been traveling a bit, so I'm going to leave a little bit of extra time for the Q&A today. We're only going to do one segment. I'm going to talk about basically several variations of the short volatility trade, sharing a bunch of data with everybody, answering a question that I get in some variation of it many, many times. So we're going to dive into that. But remember, I don't tell people what to do, what not to do. I'm basically just here to share my work. I've been doing this for 20 years, so I've pretty much got this all figured out myself for my own trading. Been doing research a lot, been doing live trading for a couple decades, so I've learned most of the mistakes. I've had some financial losses along the way, learning some hard lessons, and I'm just sharing my data with everybody. So if you do get to the point where anything I say, you're like, well, I can hear your warnings, but, you know, appreciate the videos, appreciate the live streams, but I'm just going to go ahead and do it my way. If that's where you're at, that's fine. But just, you know, consider me somebody to bounce ideas off of, devil's advocate, maybe talking you out of doing some silly things. So if everybody can hear me okay, I don't see any comments. A couple questions, we will definitely get to those. But yeah, let's just dive right into it. So what we're going to talk about today is essentially, this is the form of the question. Came up yesterday again, so I thought, oh, that'll be a good topic. But it, like I said, many different variations of this. Essentially, Steve here was asking, if the short volatility ETFs go up long term, why not take a smaller allocation and just buy and hold them? So he's talking about things like the SVXY, the SVIX, the inverse products. They do go up long term, and we will get into that, of course, in a minute. But, you know, one of the things that I do like to touch on whenever we're talking about the short volatility trade is somewhat address the elephant in the room. As we all know, hopefully we all know at this point, that the long volatility ETFs, here's the VXX, of course, here's the VIXY, materially identical to the VXX, just, you know, an ETF instead, different issuer. Here's the UVXY, of course, diabolically down. The UVIX, we know these things go down long term. So before we start talking about the things like SVIX and whatnot, we do want to start talking about the very simple thing. Well, why wouldn't we just short the long products instead? Why wouldn't we just cut out the middleman, forget about those inverse products? Let's just go ahead and short the UVXY because, you know, obviously it's pretty direct. It goes down all the time. Wouldn't we make a really nice rate of return? And it would be super easy to do. So just before we get into the SVXY stuff, I do want to sort of cover 3 or 4 reasons why maybe you wouldn't do that. And like I said, don't consider this like I'm telling you don't do this, but some of the things that I'm going to talk about you may not have been aware of. So important stuff. Seeing a lot of questions. One of them just caught my eye. Interested to answer that one. All right, so essentially, let's do this really quickly. There's basically a few reasons why you wouldn't short them directly. So the first one, of course, should be the most obvious one. It's a trade with unlimited loss. Whenever you're shorting something, doesn't have to be a volatility product. You short Apple, you short Tesla, you are on the hook for unlimited losses. Now, that might not be a problem if it was a fairly consistent stock, but of course, UVXY, this is a wild ride, and it might not be a very good idea. So just as a basic example, UVXY went up about 1,500% during the pandemic. And got to remember that the government came in and threw trillions of dollars at the problem to stop the bleeding. We don't know how bad it's going to get next time. Certainly the financial crisis would have been worse. But if there's an extended recession, it could be significantly worse than 1,500. But even 1,500%, you're talking about going up 15 times. So even if you shorted with, say, 5 or 10% of your capital and you were to buy and hold it and you didn't have much risk management, well, you could be on the hook and you could lose most or maybe all of your portfolio. So not only would you burn through all your short vol stuff, but you'd just obliterate all of your money. So obviously a non-starter. Another reason you might not want to do this, people don't know this until it happens to them live, but oftentimes the brokers will raise margin requirements during a crisis. So if volatility spikes up, you might find that you wake up one morning, you're in a margin call, you're like, what's going on? I thought I had plenty of room. But you'll find out that your broker, because they have to protect themselves on their end as well, that they've raised the volatility margin requirements for some of these ETFs. And the trade that you had on, maybe it's not going so well, but you wanted to do risk management, you can't, right? Because now you're in a margin call, it's just way too much, and you have to close it out and just take your losses. That will suck. And that's one thing that kind of blindsides people. They don't know that happens, but it's actually very, very common when volatility starts to rise, you will see these things start to be adjusted. The third thing that you can actually see here, this isn't, universal for everywhere, but if you look at the borrow shares, if you're trying to short the UVXY and just borrow the shares, right? Because that's what you're doing when you short something, you're borrowing it from someone else and you're paying them a fee. You can see the red line here. This is a pretty good estimation of the fees. And you can see in good times, it's, 15, 20%. That's a lot, right? That's a huge anchor that you're basically throwing out the back of your short volatility strategy. And you have to overcome that hurdle just to break even. That's a pretty big thing. But you can see at times when volatility spikes, like just this previous August, it went up all the way to, 50% for a couple of days, but 30, 40%, it happens. The point is fees are extremely expensive. And a lot of times people don't factor this into their trading. Sometimes you'll see people say on Twitter, for example, it's a really bad issue where people will recommend somewhat ill-advised short vol strategies because it gets a lot of eyeballs, right? They'll talk about the risky stuff because, people are really interested in that. Why don't we short naked calls? Why don't we short the UVXY directly? But it's funny, they never really mention the negatives, right? They're just trying to get eyeballs on their work. And of course, they'll say that they make these massive returns, but they never actually show any performance. They never show any real trades. So, you don't know what's going on. But the one thing that I have noticed is almost none of those people actually talk about the list of negatives here. So they don't talk about margin requirements being massively increased. They don't talk about the unlimited risk. They certainly don't talk about the 15 to 30% fees that are involved in doing this trade just to break even. And another thing they don't talk about is, let's say you do get caught in a bad trade, like that thing in August, it did catch a lot of people off guard. You can be forgiven if you didn't fully see it coming. Spoiler alert, our community, cycled out and into safety well ahead of it, so we didn't get hit by it. But you could forgive yourself. You could see that some people might have gotten caught. But what ends up happening is you might want some additional time to do your risk management. Because again, we know that if you just hang around and wait a while, everybody's going to be saying, well, just wait a few months, it's going to go back to where it was before. The problem is, and you can kind of see that in these blue bars, is the shares might get called away on you. And the time that they're going to get called away on you is at the time that you least want it to happen, right? You're not going to get your shares called away on you when the market is calm and everything's stable because people are just in their positions. But the time that you're going to get things called away on you is during a crisis. And that's the exact time that you would not want that to happen. You would want another couple of months to fix your trade, but then they come in and say, sorry, you've been called away, and there you go. Your trade is now locked in with those losses, and you're kind of screwed. So all of these things combined, yes, it's true that, shorting it long-term, it has a long-term annual return that's pretty significant on the downside. But when you factor all these other things, unlimited risk, the risk of getting called away, the risk of margin requirements, the fees involved, basically it's a non-starter. So this is something that it looks very appealing on the surface, and it certainly plays well with the eyeballs on Twitter, but it's not something that you really want to be doing. Again, if you want to go for it, take my warnings and strap in for a wild ride. But I'm just trying to give people a heads up that it's not all it's cracked up to be. You can't just look at a long-term chart and say, oh, look at that, it goes down, let's just short it. Doesn't work that way. What if it spikes up, 1,000% in a day or two? Then what? What if there's a cyber attack, a flash crash? I mean, you're in big trouble, and your losses might be locked in the very next day. So, and not maybe, it's actually pretty common for that to happen. So, let's hopefully learn from these lessons, and I've certainly made a few myself. And let's assume that you understand that you're not actually going to be shorting the UVXY directly. Well, let's talk about buy and hold on the inverse products, because here's the SVXY, and this is long-term. The SVXY launched in 2011, so it's about right here. Oops, I shouldn't do that. It's about right here. Hopefully you can see my mouse cursor. But we can simulate the prices back to the launch of VIX futures in 2004, and you can see that the annual growth rate is 13.83%. So pretty decent return, right? And I would say, obviously nobody can see the future. I can't predict the future, but I would say that I would expect over the next 10 or 20 years that rate of return would roughly be the same. I don't think this is an aberration. I think going back to 2004, we've seen some very good periods. We've seen some very bad periods. The SVXY is probably going to average about 10 to 15% long term. So you might be thinking, well, why wouldn't I just do that, right? Just hold on to that thing. And now you've basically solved a couple of the problems, right? The first problem is there's no shares to be called away. This is a long product that you own no matter what. No matter how low it goes, you could just wait until it recovers. And the second thing is there's very low fees involved. The SVXY is less than 1% management fee. I think it's 0.95 or something like that. So you seemingly have solved the problems. But hopefully your eyes have drawn to that drawdown there, 71.99%. That's not going to be very much fun. So these are the drawdowns of SVXY since inception. And you can see that if you are going to be a buy and hold person on this, you're going to have to strap in for a very wild roller coaster here, because it didn't happen once. It happened like 3 or 4 times where it's going to shock you. A lot of people, when they look at a chart and they think, well, sure, I want my 13%, so I'm just going to close my eyes and hang on for the ride. That sounds like a good idea when it's not happening to you. But when you watch your net worth go down by 70%, trust me, the vast majority of people are going to make stupid mistakes. They're going to panic. They're going to be emotional. And that's when you're going to be doing things that are going to cost you money long term. So I would say don't put yourself in that position, obviously. These are insane drawdowns. But it is true that it is technically better than the S&P 500. Here's the S&P going back the same time frame. The drawdown is, of course, in my opinion, a non-starter. I don't think anybody can watch their net worth go down 55% and just go to sleep at night and just wake up in the morning and keep going. I don't think that's realistic. Most people, even those who think they're just going to dollar cost average, that's a fair weather plan. When everything's sunny and calm, it's great. But as soon as it's pouring rain with, all the wind and gusts, then all of a sudden you're going to do stupid things, right? You're going to be rushing for the exits. You're going to be slipping and falling all over the place. So that's what's going to happen. There's going to be a lot of emotions involved. And yeah, you're going to pull the plug and do something stupid. But technically speaking, the SVXY is better. So what about the SVIX? Now, this is the one that's going to surprise people, but I'm going to talk about the reason in a second. If you look at the SVIX, this is a -1 inverse. So technically, it should be twice as good as the SVXY, right? Because it's twice as leveraged. But actually, long term, you can see it's actually a little worse. That's weird. I just did a video recently. Maybe let's try to pull that up and do a little on-the-fly marketing for everybody. My most recent video I just uploaded yesterday talking about beta slippage. You should watch this video if you're confused as to why the SVIX might actually be worse than the SVXY. It's not entirely due to the beta slippage, but it's just a mathematical effect that when you have larger losses, you're going to be suffering even worse long-term returns. You can see here with the SVIX, you're talking about over 90% drawdowns. There is virtually nobody who could watch their net worth go down. And this is a good mental exercise. You should imagine, what is it going to feel like if I go 5 years making a bunch of money, buying and holding this thing, I'm up 20, 30%, everything looks fine, it's all easy, I'm making plans in my life, maybe you have kids, maybe you paid for a wedding, you're doing all these things, you're paying your mortgage, everything's great during the good times. You kind of bank on that at least maintaining to some level. And then you get to a point where not only have you given it all back, you're down 90% for 5 or 6 years, right? You've been living your life as if you're this investor that makes 10 to 20% a year. And now all of a sudden you're down 90%. How is that going to feel? How's that going to affect your life? Are you going to be able to do this and just go on the next day? I don't think so. That's really not how investing works. So be very, very careful. That's why I'm showing this data. I just want people to be aware of the facts. If you are planning to buy and hold something that, sure, you might make a double-digit rate of return if you were to, you are going to be in for an excruciating ride. And when you put them together, this is also the interesting phenomenon that obviously if you're going to buy and hold one of these two instruments, don't be that guy who thinks, well, the SVIX, it should return more long term because it's more leveraged, right? It's 1 times, SVXY is minus 0.5. Actually, on a risk-adjusted basis, I obviously don't recommend buy and hold for anybody ever under any circumstances, but if you were going to do it, surely you would choose the SVXY. Basically, the reason this is happening is the old ratio. It's just a mathematical gearing effect that losses are more costly than gains are beneficial. So if you start dipping down to these levels, 70% loss, you got to make 233% to get back to break even. And yes, the SVXY does go through periods where it can sustain that. It can make more than that, and it will recover eventually. You can see that these periods are actually pretty long of drawdowns. I mean, it took from basically Volatility in 2018. This is a simulation basically of this whole thing, but Volatility, it barely recovered just recently, right? That's a long time to wait. So if you're down 70%, you got 233. If you're down 90, like the SVIX, I mean, 900%. And this is another thing that you often see. You can catch these, Twitter traders kind of showing their cards on the platform when they talk about things like, well, sure, during Volatility, yeah, I had an 80% drawdown, but, I've made 100% return for 3 or 4 years since then. So, it's all good. I think they're counting on people not having the basic math skills to do the math on that. But if you have an 80% drawdown, you need 400% after that just to break even. So if you do something stupid and you lose 80% of your capital, which with volatility trading can easily happen, especially if you're shorting the UVXY or selling naked calls, it happens to these people every 4 or 5 years. If it happens, it's not good enough to make a triple-digit rate of return for the next 3 years. You're still down money. It might sound amazing, right? But you're not break even yet. So it is just a basic math thing that you are digging yourself a massive hole if you do this. But I did think people would want to be interested that it's not always the case that more leverage causes better returns. In our tactical volatility strategy, we actually use the SVXY right now. It's not half watered down, useless little product. It's actually pretty good because the return might be half as much, but the drawdowns are half as much as well. And the drawdowns hurt more than the gains help, as we saw here. So actually, risk reward, it is a better product. So what I want to do just finally before we get to the Q&A, just remind a few of the new people that you don't have to buy and hold. Of course, there are very simple low-hanging fruit methods of getting yourself out of the very worst periods. I'm not suggesting that you would be as good at this as I am. Like I said, not bragging, but I've been at this for 20 years. Believe me, I've taken my losses as well. I'm not bragging about all this. But I've learned enough lessons along the way that I'm actually really good at this point. But there are also ways that anybody could do this. You could just find a few volatility metrics that can get you out and into safety so you don't have to suffer the full brunt of the drawdowns, right? If you could pull the plug here at 50, that would be a huge improvement, right? The difference between requiring a 900% return and only 100% subsequent return, this is an absolute game changer. I've kept my drawdowns to a very low level, but even if you could keep yours to 50 or even 60, I mean, that would be very helpful. So the way that I do it, of course, is I mine a bunch of volatility metrics. Some of them are in my daily emails. You can just flash that. I know we get new people every week, so I don't mind just showing these stuff. But this is my daily email. There's a bunch of volatility metrics. I've explained them all. These are all hyperlinks. But, you could choose a couple of these and you could actually use them in your own trading. And if you were able to do that, Well, you don't have to ride it all the way. We actually cycle to safety. We're in safety right now. You can actually see our strategy as well. Tactical volatility. We are actually in gold right now. We cycled out, 3-4 days ago. I think the market is just getting decimated today. It's down 1.7%. What's gold? Gold is down 0.8. SVXY is down, 5.38. So there is differentials that you can capitalize on if you're willing to move to safety. And then, of course, on very rare occasions, we can actually go long volatility and hopefully make a bunch of money when the market crashes, right? If there's some extreme event, we certainly want to take advantage of that because they don't come around very often. And that's really the only purpose of long volatility, is just to kind of grab some easy profit for a couple of weeks when the market is melting down. But that's what I do personally. Like I said, there are some low-hanging fruit methods that you could use yourself if you're not, don't want to pay money to join our community. VIX futures is a good start. VIX index is pretty garbage. I'll get to a video about that soon. But, things like that, volatility risk premium, just develop some basic signal and you don't have to lose 90% of your capital. You don't have to ride that down. So again, at the end of this, long rant here, answering our friend Steve's question, it's a total non-starter. No, you would not want to do this. The only circumstance you would want to do this is if you really had absolutely no clue what you were doing, and you're just the most disciplined person on planet Earth, and you know for a fact that you're not going to go in and meddle with things when they're not going well. You're just going to ride it to the end. I don't know what investor would fit that category, to be honest. I mean, who's in that box? I don't know. Buy and hold investors are very confusing to me because what ends up happening, and they're all over Twitter, just buy and hold the S&P. You'll never beat it anyway. People can't do that. For the most part, they just can't do it. Like I said, this is not something where you've got a pile of money on the side and you don't really care about what happens to it. This money that you are buy and hold in the market, this is your life. This is the centerpiece of your life. Anybody who thinks money's not important, I don't know what to tell you. It really, really is. So you've been living your life under certain rules and spending habits and budgets and future plans, and then all of a sudden the market does something crazy and half your money's gone, 2/3 of your money's gone. And now you're thinking, well, I've only got 10 or 20 years to retirement. Now what? Well, now I have to try to fix this, right? I have to get in there and do something. This could take 10 years to recover. Trust me, very, very few people actually can buy and hold. I know there's a lot of people online that tell you that that's the best way to go about investing. It's really not. That is a very, how should I say it without being too insulting? I would say that's a very inexperienced view of how investing works. And the truth is, 90% of investors were not trading during the financial crisis. They simply don't know what it's going to feel like when they lose 60% of their money. They've never experienced it. They started investing in the last 5 or 10 years. They weren't investing 15 years ago when it really did look like I'm down 55 and if I don't do something, I'll be down 80. It really was that bad. People have forgotten, or people just simply were not investors when it happened. But that's going to happen again. I'm a person who participates in market rallies. I'm always fully invested with my capital and my strategies, but I'm not dumb either. This economy is headed for a crash at some point, maybe within the next year, maybe not for 5 years. But there's going to be something that absolutely rocks your opinion of buy and hold to the core, and I don't think it's a good way to go about investing, especially since there are so many ways that you could apply just a few basic filters and you don't have to ride it down to, Armageddon. You really, really don't. So if you need help with that, or maybe for just 6 months, you want to jump into the community for 6 months, learn everything you can, and then go off on your own, that's fantastic, right? That's great. We will part as friends. But if you want a little bit of help on what this tactical investing stuff is all about, of course, go to the website. There's a free trial available for everybody. Take the free trial, check out my work. You might find it useful. And if you don't, like I said, you can still tune into my live streams and we can still be friends. It's all good. So, there you go. No buy and hold for our community, that's for sure. Let's get to some of these questions. All right. Oh, man, there's a lot. I figured because I was gone, and as I'm speaking, there's going to be more and more. Let's rifle through these. What the time is it? It's 24 minutes. I guess you got through that quickly. I ramble a lot, as people probably know. Okay, Rod, I love to hear thoughts on spreads you're seeing in VXX, of the spreads you're seeing on VXX, other products. I'm finding them increasingly wide and undercutting my call credit spread risk return views. So I've noticed that as well. I've talked about that in a couple articles and stuff recently. I suspect what has happened, because you have to remember that on August 2nd, we saw one of the largest volatility spikes in history. I believe it was the 6th. In fact, hold up. That's what spreadsheets are for. Here we go. It was number 7. That was the 7th largest VXX spike since 2004, since the VIX futures launched. And then one day later, on August 5th, we saw the largest volatility spike in history. So we saw, I mean, we can quantifiably say, if you're talking about number 1 and number 7 in a back-to-back days, that was the biggest volatility spike we've seen, certainly in a very, very long time. As big as any we've seen. But then what we also saw on the 6th was the largest volatility crush we've ever seen in our lives. Like, that was just absolutely insane. VIX gets to 65, and then it was immediately back to the 20s. Like this, we've never seen whipsaw like that in the volatility markets before. So what I suspect is happening, and what you're noticing, because the options market is essentially just a group of buyers and sellers, right? It's a freely traded market. You can't expect it to be perfectly efficient when the market is all over the place, right? So you're going to see market makers don't know what the hell's going on, so they have to widen the bid-ask spreads. They have to protect themselves. Traders don't really know what's going on, so they have to get in there. And some people probably have terrible trades on. Some people have trades still from back then that they just abandoned. So that's going to cause the pricing to be a little bit weird. Bottom line is, we're seeing some craziness. And while I can't say that I've noticed that my actual fill prices are bad, I still have noticed that I'm getting decent fill prices. Certainly the bid-asks are wide. And another thing that I'm noticing is that the premium on different strikes is also very weird. So as an example, I've got many different volatility strategies, but just like as an example, I could choose butterflies, right? Our VXX, UVXY butterflies, or Wheel of Fun, just selling VXX put options. That'll be a good example as well. But what I've been noticing is, normally, when everything's behaving normally, I always say the options market is, for our purposes as a retail trader, it is efficient, right? So there's not going to be a whole lot of arbitrage opportunities for us slower moving retail traders. But after such wild and crazy markets the last month, I've noticed that it's not smooth down the premiums. I don't know if you've noticed this as well, but sometimes from a risk-reward basis, you can go down a strike or two and you can substantially change your risk-reward profile. I've also been noticing this in the iron condors, for example. I've noticed that, my normal roughly 15 delta on either side iron condors, I've been sort of manually overriding them to take the better strikes. Our VXX, like I mentioned, the broken wing butterflies, I have sort of, typically I try to follow the general decay factor of the volatility ETPs. Like I list them out in our daily email every day, from 1 day change down to the 5-day, 10-day, 21-day. I try to stick roughly to this, and then maybe I'll drop it down 1 strike just to account for the fact that we don't want it to go past. But I've definitely noticed recently that I've just gone ahead and manually overridden some of these trades, because 2 strikes over or 1 strike over, the premiums are way better, right? And just substantially different. So yes, a very long babbly way of saying you're not wrong. Like, things are a little bit weird in volatility land right now. And that is a result of massive confusion, plus the actual implied and realized volatility proving to us that there's something to worry about. This isn't just fear for fear's sake. This actually happened. We had massive, just epically large volatility spikes, and then vol crush like we've never seen on flushing out the other side. So we cannot expect this to be too efficient. I think that's what's happening. It is what it is. With options trading, of course, the basic rule that you always live by is sell things that are overpriced based on your models, and buy things that are underpriced. So like I said, if you have to skip over a strike or two, don't be afraid to go looking for better premiums. Sell the ones that are abnormally high and buy the ones that are abnormally low. Yeah, you can do that. Actually, you know what? I think this might be worth expanding. But you can also just go into the product itself. Like let's say you're doing an iron condor on the SPY. You can go to the strikes. Let's say I was doing, I don't know, December contract. You can actually go into these and you can try to isolate which strikes are actually paying slightly better premiums. Sometimes you can go in here and you can see that, okay, well, this one is dipped. Maybe there's a little bit of a spike on some of these. And sometimes you can say, well, it would be more efficient to sell this one and buy this one, even though the delta would say that I was supposed to sell this one. You can see that the premiums, if you really dive deep into the software, you can see that the premiums here would probably be better to sell this one and buy this one. So don't be afraid to go into the product depth and actually examine. Small inefficiencies can make a big difference long term. Don't forget that. Little pennies add up to dollars when you're factoring 20, 30 trades, extended over a year. It can make a big deal. So there was probably an answer in there somewhere to your question. All right. Johnny YouTube. I remember this. I thought that you were standing on a golf course last time, but we went back and forth and you assured me you weren't. What did you say you were? You were sitting on a chairlift or something? I can't remember. Sorry about that. How close did we come to moving from safety to defense in the last day or so? I assume what you mean by that, oops, I didn't screen share. I assume what you mean by that is going to full on aggressive positions. So defensive, not that close, to be honest. It would take, well, would today be, today is probably enough. Let's see where things open on Monday, but it wouldn't surprise me if we were getting awful close now. Got to remember that I sent my email, I think the S&P was down 0.3% when I sent my email. It was basically flat, and it was actually even up a little bit when I was preparing today. So I would imagine that these dials are going to be significantly pushed downward. Is it going to be close enough? No, probably not. No, we're not going to get there in any of the three, I don't think. But the day's not over yet. The market still has a few hours. We will see. Things are getting interesting. Just when we think, we went through a crazy cycle in August and now everything sort of seemed to be calming down. And now out of nowhere, just the last week, it's been pretty rough this week as well. So dangerous market. Tactical investing, while it's not pretty, like we don't always get it right. Sometimes we exit a day late. Sometimes we get hit with something that we wish we exited the day before. It's not pretty, but when you stretch it out over longer periods, I would much rather get a little bit of a whipsaw here and there, maybe suffer a few paper cuts along the way, rather than just be hard-nosed and stay in positions and just watch them just get tanked. So we're out, we're in safety. We exited a couple days ago. And we're just kind of on the sidelines, just watching it all unfold. We will see. I don't know if this is the big one or not. I doubt it. But if it is, we're positioned pretty well. All right. The returns of your portfolios on the site are since 2012. Yeah, that's when I launched VTS. I've been trading a lot longer than 2012, but I only post performance based on trades that went out to a third party, subscriber. So I didn't post any performance before 2012. Let's continue. Thus, following the 2008 crash and during the long bull market that followed. Please see next message. Do you think it will be harder to get such great returns with your strategies after the next crash, especially if the market takes time to go up again as you use many market ETFs, SPY, Qs, XLU, all that stuff? So great question. Obviously, I don't know for sure because I was trading back during the financial crisis, but back then I was a pure option trader. I was not doing these tactical ETF strategies. That started for me mid-2010-ish is when it really started for me. So I don't know, but I'm quite confident that the strategies will more or less track what I've been doing, because the reason my investing style works is not because I have some crystal ball method of predicting the markets. It is, I'm not going to say it's entirely mathematical, but you know how I always refer to the fact that, say, volatility drag, this is not volatility products are garbage, that's why it's happening. They're manipulated, that's why it's happening. No, this is just a pure mathematical formula. If you avoid drawdowns, you will be better off. This is why I always say on Twitter, I've got several of those saved tweets that just tweet for me, like 3 or 4 times a year, it's just programmed to tweet for me. And I know that one of them says, the best way to improve your long-term rate of return is to reduce drawdowns. That is absolutely true. That is essentially what I'm doing. I'm counting on the fact that if you stretch it over longer periods of time, the more drawdown you can avoid, the better off. Now, the flip side is it does sometimes mean that you miss some of the upside. That does happen. Like tactical investing is essentially try to catch most of the uptrends, but you're never going to get all of it. Nobody has a crystal ball and can just exactly predict the market reversals. So try to get most of it, and you will underperform the market when it's doing very well. If the SPY has a killer year, I'm probably going to underperform the market. But if you reduce most of the drawdowns while missing out on some of the gains, that drawdown avoidance cancels out a lot more, and long term, you end up making a way higher rate of return. So that is essentially what I'm doing. I'm not making decisions from day to day on these trades. I'm just telling to myself, like this week, 3 days ago, we exited to safety right there. We exited to safety. We're out of short vol and we're into gold. I don't know what's going to happen. For all I know, it's going to go up. And what ended up happening is I exited short vol. I saved myself, let's go to the SVXY, saved myself a little bit. Maybe it recovers up here, and maybe it actually goes higher than the point that I sold it at, and I bled a little bit of capital. Fine. Maybe I lose 2 or 3%. But what I'm trying to avoid, obviously, is every few years this happens, and I get to be out of that. And sometimes, sometimes I even get to be in the long vol stuff and actually profit from that. So this is a very long way of telling you that I actually am quite confident that my style of investing will always work the same. Maybe not the same numbers exactly. I mean, nothing exactly rhymes, but the reason my investing worked so well for so long is because of that drawdown reduction. That's what's happening here. I am telling myself that I'm willing to forego a small bit of the upside in exchange for avoiding a 6-year recession, right? This is the thing that's a hang up for a lot of people. They want to participate in the market, but they know the market's going to crash eventually. Well, what do you do? In that situation, how do you even, you feel handcuffed, right? How do you even invest when you know for sure the market's going to crash, but you also know that it's might actually go up for a while as well? Well, you've got no choice. You have to be an investor like we do, tactical investing. We have to have dials and levels where, okay, if it's here, I'm going to be short vol, I'm going to be long equities, and I'm just going to trust the system. But if something happens, I can be out in a day. That's the advantage here. So what's going to happen on the next market crash? I don't know exactly, but I can probably tell you that on the way down, on the extremes, volatility will signal warnings. You can't have a major recession and not have volatility reflect those signals. So we're going to be well out and into safety. And then the market's probably going to bounce very strongly, right? After a 6-month or 1-year recession, there's going to be a lot of appetite for buyers to come in, and we'll probably miss the first few weeks, right? There's going to be a bounce there. Volatility metrics stay elevated, and we'll miss a couple of weeks, right? That's what you suffer when you're a tactical investor. You can't get in right on that V bottom. It's just not possible, right? The same signals that got me out into safety are the same signals that kept me in for a week or two too long, right? So we're going to miss that initial bump, but then the market might go up 200% in the next 3 or 4 years, and certainly we're going to participate in quite a few of those uptrends. So in general, that's what I'm expecting. Returns might be a little bit lean, and they have been for several years because the market's kind of running on fumes. One week it feels like it's just going great. The next week it feels like it's going to crash any day. Since 2018, we've basically been running on that 2 steps forward, 1 step back type of market. We're going to get a big hit, and then it's going to reset. And then we probably will get 4 or 5 years where there's mostly confidence in the market. And rinse, repeat, the next cycle begins. So that's what I'm expecting. Got a couple of strategies. I can make a note of this. Sometimes I like to take a picture of the questions. I can make a note. I can actually show you what our strategies did in 2008, just with the caveat that it wasn't live trading, but it's all 100% quant based. I can just show you the performance and you can get a good idea. So maybe we'll do that next week or 2 weeks from now on a live stream. And I'll just give all the normal disclaimers. Past performance is not indicative of future results, all that stuff. But yeah, you'd be surprised. The tactical investing works pretty well through a recession as well. All right. It looks as if we are moving SPY to IYR and later when down QQQ, QLD in my case, to XLU a day later with extra loss. Yes, we cycled to safety in tactical vol and strategic tail risk a day before defensive rotation. So let's keep going. I got the feeling as if moving both instead when one has to be moved may be better. So I think what you're saying here is moving all three strategies on the same day might be better. Like when we moved to IYR, we stayed in the QLD and we moved from SVXY into gold. And that happened on this day. But let's pull up the Qs. We exited to safety here, but we exited to safety in the defensive the next day. So of course we've avoided today's, down 5.45% so far, but we exited a day later. What I will tell you is this is the level of diversification. So there is of course some correlation between our main three strategies because during good stable markets with mid to low volatility, we will be in the S&P 500, the NASDAQ, and short volatility. Obviously, there's correlation there. But in order to have three strategies together be better as a triple pair rather than just picking one of them, we have to add some diversification. So the first level that I add is all three strategies are using a little bit different volatility metrics. So they're not all getting their signals from the same place in the market. It's, again, correlations, obviously, because we're talking about a broad market of volatility metrics. But for example, because this is a volatility ETF, this strategy leans a little bit heavier into the VIX futures market to get their signals. The defensive rotation, it's all stocks. This one goes a little bit more towards the S&P 500 metrics, volatility risk premium, things like that. And strategic tail risk, again, has a focus that it might catch those tail risk opportunities a little bit faster. So they're all different. And then the second level of diversification is they're all using different safety ETFs. So gold, XLU utilities, and IYR real estate. As a pair of those three, with a 33% allocation to each, that's going to be better and more reliable than any one of them on their own. And then the third level is these threshold lines, while they may look similar on paper, they are actually in different spots as well. So we've got essentially what I call our 3-point diversification. We've got different volatility metrics, we've got different thresholds to get them in and out, and we've got different asset classes in all of those ranges. And it means that, sure, in stable markets, none of this stuff matters. Whether you're long equities or short vol, it's a short vol trade and you're going to be making money. But what we do exiting to safety, that's really the secret sauce to what I do. And it is important that all three strategies are different from one another. You wouldn't want to be just having them all basically the same. What would be the point? And then you just choose the best one and save yourself the headache of, it's not really a headache, but different allocation sizes. Why bother? Just pick one. 3 is better than 1 for sure on a risk-adjusted basis. So that's what we do. Traded UVXY this morning. Yay. Okay. You obviously mean long. You obviously jumped into a trade when it was probably down, and now I would imagine it's probably not getting shocked, but it's up 15%. So yeah, I agree with you. Yay. Not a trade that I do. I don't try to be a contrarian with volatility. I don't buy long vol when it's really low, like hoping that, okay, I know the market's going to crash. I don't do that. I don't know what made you buy long vol today, but it seemed to have worked out very well for you, at least now, right? The problem with long vol, well, there's many problems with long volatility trade. It is the most difficult trade to profit from, bar none. But it's not, like, entries is hard enough, right? To actually get a trade that makes money, that's really difficult. I mean, to thread that needle, we've seen the long-term charts. You're honestly telling me that it's easy to thread this needle and find a profit on the long side? Not really. But what's even harder than that is knowing when to get out, right? Because now what do? Presumably you're up about 15%, and you maybe even bought it when the market was down, or when the market was up, UVXY was down. So maybe you're up 20%. When do you take your profit? That's just as hard to figure out. So, yeah. Here's somebody, Ethan, saying borrow rate for UVXY is 18.6 right now. Interactive broker. Let me just check my other standard website. I'm seeing 19. So, yeah, I think that's a pretty good. You can assume that it's going to be 15 at best, but probably an average long term of about 25%. You know, you're talking about a major drag, right? Like, to use another analogy, like somebody might think they've got a really fast boat or something, but throw out a huge anchor behind the boat and see how fast your boat is then, right? It's something that nobody talks about, but it's just a massive drag on what you're doing. The ETF itself, even if you thread it perfectly, you could only expect maybe 50 or 60. You got to take on extreme risk. You got to worry about getting your shares called away. You got to worry about the brokers. They're definitely going to raise margin requirements. They might even have done that today, right? It's just a nightmare trade that in the end, it's super inefficient. It's way too risky. It's way too expensive. And quite frankly, there is a dozen better ways to short volatility that are smarter, safer, and long-term more profitable. So I always view hey, let's just short UVXY shares. This, again, I don't mean to, belittle anybody, but it strikes me as a rather rookie strategy, to be honest. It's the same as the people who sell naked calls. It just strikes me as sort of the entry-level stuff. That might be a good idea when you first start, but it doesn't take very long before you realize, it is an insane capital inefficiency to sell naked calls on UVXY. You're tying up enormous capital. If you just turn that into spreads, or if you flip it and you actually go butterflies or iron condors, you're talking about getting 20 times the capital to work for yourself. It just stops making sense very, very quickly. So selling naked calls, selling UVXY outright, I get why people do it because they look at the chart long term and they just think, I can't possibly not do this. But I think that traders, once they start crunching numbers and expanding their horizon with different types of strategies, I think they learn quite quickly that efficiency in trading matters a lot. And those strategies just don't hold up long term. I'm not saying they can't make money. This is another thing people often assume, like, he said you'll lose money. No, I didn't. I just said there's far better ways, right? The goal of trading isn't to make a positive return. There's lots of things that'll make a positive return. The goal of a trader is to make the most positive return with the least amount of risk. And that's where it falls short. Maybe you'll sell naked calls and maybe you'll make a positive profit. But I promise you, if you do butterflies, you'll make even higher profit with less drawdowns. So that's more what I'm saying. And those fees, crazy, crazy, crazy fees. And they can go up, they can double or triple overnight. So that's not fun. Taiwan, Dubai, you sound American. Have you spoken with a tax attorney to allow you to live how you live and keep a greater percentage of profits? Good question. I'm Canadian. I'm not offended. I love America. I lived there for 8 years, lived in 5 or 6 different cities. No problem with America, but I'm Canadian. So, the reason he's asking, for anybody wondering, Americans cannot avoid taxes no matter where in the world they live, right? I think there's 108,000 or 111,000 barrier that you have to clear. You get an exemption if you're overseas, but eventually they're going to get their money. For me, it doesn't apply. I haven't been a resident of Canada in over 20 years, and I actually haven't been back to Canada since the pandemic. I got trapped there for a little while. People might remember that I got trapped in Vancouver, and then they closed the borders and they, didn't let anybody leave the country and forced you to go to Bill Gates's house, as I always said. So I had to do what I had to do to get out of the country, and then I haven't gone back. And so, I'm a up and up, law-abiding citizen that is living in tax-free Dubai. But my wife's Taiwanese, of course. I've lived here for many, many years, and a good 6 months in Taiwan as well. Great country. In fact, no, don't highlight that. I just wanted to say something because it just came up recently, but the 2024 rankings for the safest countries in the world came up. I watch a guy called the Nomad Capitalist. He's really good. He's got a massive YouTube channel. And I haven't used him for any help. I just find him entertaining. I'm doing my spreadsheets. I listen to him in the background. But he just did a video recently about the safest countries in the world. And UAE, of course, was it was actually second this year. That's surprising. Dubai's usually first or close to it. Second this year, I think Qatar was first, or Qatar, however you want to say it. And number 3 was Taiwan. So I'm doing pretty good. I basically live in 2 of the safest places on earth. And one thing that I wish, because sometimes people call me a traitor to my country because I left and I went to Dubai. I was a professional golfer for many years, so I was traveling the world. It was just part of my job. So when I retired from golf, it just seemed odd for me to just go back to Canada and just live in Vancouver. So I just kept my nomad lifestyle and just kept traveling, and I just started a new business, and I'm doing the same thing. I'm traveling the world, and I'm always on the road. But this isn't like I'm a traitor to my country. It's just my own. This is how I've always lived. But people call me a traitor. But where was I going with that? But anyway, what I wanted people to experience is what it feels like to actually be in a safe country. I think a lot of people don't actually know that. A lot of Americans don't know what it feels like to be in a country with literally zero crime. Like it's just feel what that's like. Go to Japan, right? Just go to Japan, go to a Starbucks, open your computer, put your wife's LV or Chanel bag on a chair, and go into the mall for 10 minutes. Nothing will happen to your stuff, right? You can do that in Taiwan. I wouldn't do that in Taiwan, but you can do that in Dubai. People mark tables with, Rolex watches, and girls put their Hermes bags on the center of a table at Starbucks, and then they go, into the mall and go shopping. Americans, Canadians, Australians, Europeans, they just don't know what it feels like to be in a country with no crime. So just experience it once. Might be worth it. And not for nothing, having zero taxes is pretty cool too. So, but just on that side note, we'll just wrap this up really quickly. But I think his name is Andrew Henderson from the Nomad Capitalist. Smart guy, good guy. He always talks about how he does everything legally. He's American, but he gave up his American citizenship so he could live the nomad lifestyle and not pay taxes. So that's always a choice. But certainly you'd want to structure it so you get yourself another passport that's just as good. You'll never get a Dubai citizenship. You'll never get a Dubai passport if you're not from here. So you can't renounce your citizenship and then move to Dubai and live tax-free and think you're okay, because you might want an actual home country with a good passport. And that's not going to work. If you're counting on a UAE passport, you're never getting that. So anyway, that's just my private life. But people ask all the time. So I think a well-managed short position on VXX isn't as bad as most people think. I hold about 10% of my net lick short to give room for vol expansion. So again, I would tell you that I'm not telling you that you will lose money doing this. That is not my point. But what I'm telling you is when you back out the borrow fees, when you back out the fact that it's unlimited loss trade, and presumably the rest of your portfolio isn't short the stock market. So when your VXX position blows up on you, the other portfolio positions you have are also probably not very healthy either. So your 10% on VXX is going to very quickly turn to a 20 or 30% portfolio-wide loss, right? That's what going up double or triple happens quickly. Then the rest of your portfolio is getting hammered as well. Then the brokers raise margin requirements on you, and you have to trim half your position because you're forced to liquidate. And then your borrow fees go up from 3 to 4% on VXX to something like 10 or 12. And then your shares get called away on you. And now what? And so all in all, again, I'm not telling you that you're going to lose money. Net, you might be positive doing this. Like you said, if you manage it well and you know the risks and you've got some type of system, maybe you'll make a positive return. All I'm telling you is it's stacked against you, and there are many better ways to do this. You don't have to buy and hold 10% of your account in short VXX. You just don't. Just log into VIX Central. Watch how easy this is. log into VIX Central. When these front 2-month futures are below this green line on the VIX index, close your position. That's it. When the VX30 to VIX roll yield is below 0%, which happens on about 16% of trading days, close your position. I just doubled your rate of return. That's what I'm talking about. Nobody ever said you're going to lose your account, right? All I'm telling you is it is dirt simple to beat this. I mean, not to be insulting, I love people asking questions, but in my sleep, I could beat this strategy. Like, it's just the lowest hanging fruit to improve on this. So what I would say is, good start. If you've managed to be doing this for a while, great, but now start thinking about ways that you can make it better. And what you will probably very quickly find is, not that you're embarrassed, we all started somewhere, but you might look back and say, boy, I can't believe that was my strategy. Like, it's just so much easier if I just do X, Y, and Z. And so use this interaction on this live stream as the jumping off point to take what has obviously worked for you so far, and I invite you to do better. You can do better, for sure. Don't think much option volume on UVXY, not sure. That might come back to the old question of, like, recently we're seeing a bunch of craziness in the options market. UVXY is certainly very tradable. You might see wide bid-ask spreads, but you should really get really reasonable fill prices somewhere in the mid. I've never had trouble trading VXX or UVXY. Those are my two. I've got about 5 or 6 short vol strategies, and I divide them up between VIX options, VXX options, and UVXY options, and then, of course, SVXY as the ETF. So I've got about 4 or 5, and they overlap, and, but those are my instruments, and I've never had trouble trading them. Cash VIX term structure is flat now, but obviously the term structure means nothing. Remember, the shape of the term structure, the contango itself, is completely irrelevant. What you're looking at is, where are these futures in relation to this VIX index? Let's go back to the old YouTube channel. Of course, subscribe to my channel if you haven't already. What are you doing with your life if you're not a subscriber? But go ahead and watch this video. Why do volatility ETFs decay? VIX futures rebalancing myth. Go watch that video. This relationship of the front 2-month futures does not do anything to the price of the volatility products. What does is, if these are below this for an extended period of time, then you're going to get some negative roll yield. So that's what we're talking about. But correct, yes, things seem to be getting out of hand a little bit quickly in this market. So yeah, not surprising that it's flat. Little surprising though, because that crazy election future is kind of interfering with all that stuff. Won't affect the pricing, but makes it look all weird. Okay. You can do synthetic shorts with UVXY options for around 7%. Yep, you could. You could do stock replacement, and all of a sudden you're doing way better. You could do all kinds of things that are just better, right? That's what I'm here for. Like I said, I don't tell anybody what to do or what not to do. If you want to go ahead and short UVXY shares, you go right ahead. But at least listen to my 5-minute spiel about all the things that are stacked against you, the fact that you're throwing out a giant anchor behind your boat, and it's not necessary. There's a lot of very quick things that you can do to just adjust it here and there. And yep, that would be one of them. You could do, selling puts and buying calls, and you could do all the risk reversals, no problem at all. So yeah, I explore better ways. What I probably should do for a future live stream is sort of gather my thoughts a little bit better and maybe rank like the 15 or let's say 12 main methods of shorting volatility and just do a power rankings. What's on a risk-adjusted return, on balance, what is the most efficient, what's the best, and going down to what is the worst. Now, again, I will reiterate that let's say I made that list and selling naked calls on UVXY was last on the list. I suspect it would be last, right? Just because of the enormous capital that you have to tie up for a tiny little, like picking up pennies. You sell an option for 40 cents and you've tied up $6,000. Like, it's just ridiculous people do this. But anyway, that would be worst. But I'm still not saying that you'll be negative. That might actually still make a profit. So Don't get it twisted. You might make 10% selling calls, like naked calls, long term. You might make a 10% return, but I'm trying to get you to that 20, right? And there's many ways that you can go above that line. So maybe we'll look forward to the power rankings soon. Okay, this is interesting. There's a back-to-back here. So your margin on a cash-backed long position should never increase. Well, if it's involving options, then, all bets are off. But if you're long SVXY, long SVIX, yeah, you should be fine. If you're short puts, then you will see margin increase. But as long as they're cash secured, you won't have much to worry about. Cash secured is definitely better. And that is one thing that we do within our community, of course, but we're not selling the shares. We are long VXX put options, right? For anybody who's in the European Economic Area, for example, some people are trading in cash sheltered accounts, and you can't hold SVXY because of the structure. Some Americans have issues. I think it's like some tax number, 1099 forms or something, K1 forms involved. Some people can't hold the shares directly. So for those people, we do stock replacement. And yes, there are certainly ways that you can use the options to simulate the short volatility position. I think that's what you're getting at with that question. And yeah, you're right that as long as you do cash secured, meaning that even though the option is very efficient and you could sell a massive position, you assume that you're using the relationship to the ETF and you only assign a certain amount of capital in case you were assigned the shares, then yeah, you're going to be much better off. But again, that already takes us far away and far better off than just carrying a buy and hold short ETF position. That would be stock replacement with options is a massive improvement on selling naked options or buying or selling the ETFs, right? So you're kind of agreeing with your previous statement where you said holding a constant 10% short. Now, a few comments later, you're saying like cash secured, long. I mean, you've improved on it already. I said take it as a challenge to improve. That didn't take more than a couple minutes, it seems, and you're already brainstorming much better ways to do it. So yeah, I'm not worried about the margin. I think there's a conversation happening here, and I'm trying to catch up in real time. I'm not worried about the margin. It's cash secured, but I can't figure out why the excess liquidity went up today. Makes no sense at first glance. So maybe Robert here got caught. Maybe margins went up or something. Like I said, margins probably did go up today. I mean, you've got S&P's down 1.75%, maybe. Brokers have to protect themselves, and a lot of people think, oh, if I go I'll just go for broke, and if I go negative, then who cares? I go bust. Well, if you go negative, they're going to garnish your wages. They're going to come for their money. They're going to get their money. So don't do anything stupid. Don't take your account negative below zero. Just abide by the general risk management principles, and you should be fine. How close have we come to moving to safety defense? That was already asked. Yes, in Disney World. That's right. That's what it was. It was the gondola ride in Disney World, you said. I can see a sand trap behind your ear. That's golf. I don't golf anymore, so what do I know? Would you talk a little bit more about the courses that you're working on for members? So not really, because I'm just working on it behind the scenes. Options, we've got to get the options community back up and running. It was closed down a couple years ago. I just kind of wanted to prioritize the VTS stuff for a while. Had to choose between one or the other, and I chose VTS, and we shut down the options. But that's a priority to bring that back for everybody, because those are always fun strategies and totally different from what I do with the tactical stuff. So it's a good mix of both. And that's about it. I'm working. I'm a one-man show, but I'm working. RSI 14 of the VIX to VIX 3M ratio. Enter long SVXY when RSI crosses 50 down, and exit when RSI crosses 50 above. Backtest produced a CAGR of 83%. Skeptical, but okay. I'd have to run the numbers. Obviously, if you think you're going to make an 83% return going forward, I think you should go on Twitter and tell everybody about it. But I don't think it's going to happen in real trading. It's funny how that works. Like, if I had an 83% rate of return long term and I could prove it, I would tattoo it on my forehead. I mean, there wouldn't be a person on the planet that didn't see. I would carry around an audited KPMG track record. I'd be in the bar drinking beers, watching soccer with somebody, and I'd pull out my audited track record and say, look at my 83%. Do these people on Twitter that are making these claims actually think people believe them? Like, that shit would be so covered in financial news media. You've got the greatest traders on the planet struggling to make 20, 25%. And there's this guy making 100% like clockwork. It would be right here. It would be stamped. It would be all up my arms. I would be a walking advertisement of my 10-year track record of, double, triple digit stuff. So not to call you a liar, backtests sometimes look incredible when you do them because they are optimized, but just know that, pulling this number out of nowhere, but roughly 99% of backtests will fail in live trading once you start doing it, because markets may rhyme, but they never repeat. There's optimization, there's hindsight. You already know what happened, so you probably, even if you didn't overtly optimize and mess with everything, you already know what happened. So you designed the system to, I wonder if I should capitalize on that because I know it was a brutal year in 2018. I want to avoid that one. I want to design a strategy that would have capitalized perfectly on 2017 because that was the lowest vol year in history. We already know these things. So when you design a strategy, you've got to try to give yourself like a mental lobotomy to try to forget the past so you can actually do a decent structure. Otherwise, you're just going to do a confirmation bias backtest and it's going to come back looking absolutely incredible. But probably worth throwing a little money into that thing and see if you can develop a live record that's even a third that good. That would be world class. So I'd throw a little bit of capital in that. See how it goes. Maybe it's just worked out the greatest thing ever, right? Short-term capital gains is 40% in the U.S. How can I reduce this, keep my citizenship, and live in other countries like you? Well, there's so many factors, primarily being I'm not a U.S. tax resident. I'm not a lawyer. I don't know any of this stuff. I just know what applies to me. But your income has a lot to do with it because, like I said, there's a foreign minimum that you have to clear. You can do many things like starting businesses and paying yourself profits out of the business, and that saves you money. There's lots of things that you can do to reduce. But if you're American and you make a lot of money, it's very difficult to get it to zero living overseas. But if you make somewhere in the, say, 150 to 200,000 range, you can get your taxes really low if you live overseas. Much more than that, if you're getting into the 250, above 200, you're going to start to pay taxes scale up again. America's going to get you. And look, Canada will probably follow suit. I suspect in the next 5 or 10 years, because what we're seeing is just a massive exodus of wealthy people leaving the legacy brand countries like, the UK, Canada, the US, just exiting tons. And of course, inflation alone means that there's people who live there that are constantly becoming millionaires. So it looks like it's on balance, but basically you're just replenishing the millionaires that you're losing to overseas. When people see that there's a place I can go that I can reduce my taxes, there's a place I can go that's the safest place in the world, there's a place that has amazing weather, there's a place that has, all these entrepreneurs and these networks constantly going, there's a place that I don't get into politics too much, but not really into the woke stuff, not really worried about that kind of thing. It's just they do what's functional and what they care about. It's just if something is not done in the next 5 to 10 years, you're going to find that there's very few people staying left in the country. It reminds me of that movie, I think it's called Elysium or something, where all the rich people just left and they just went to the space station, that really cool space station that they had, and they just basically left all the people down there, and it very quickly turns into a hellhole, of course, right? So I can imagine the world, like, for example, the United States or Canada or Australia, turning into that, really. Like, if things continue on the trajectory that they're going and you continuously lose your millionaires and your business producers and the people that actually employ others, everybody just leaves and just leaves everybody to fend for themselves. It's not hard to see what could happen. So Dubai had by far the best ratio of new high net worth individuals moving there. It's just been a constant stream, right? Dubai is just, if you treated countries like businesses and you just went to the one that treated you the best, Dubai is the best business in the world right now because they're the ones that are bringing in all the talent, as you would say, right? The high net worth individuals that really spark the growth of a company or a country in this case. I worry about the developed countries, and I think that they're going to start to employ. Where's your question or your comment here? I know somebody said something. Anyway, yeah, I suspect that they're going to start taxing unrealized gains. They're going to start saying that if you have a passport, that you have to pay taxes even if you're not living there. Like it's going to be a mess. So certainly, I've got a few years here where I'm comfy in Dubai and Taiwan, but we'll see. You got forced to get the stick. Sorry about that. I forgot all the tyrannical certificates, advantage of living in a third world country. Yeah, like my story, it's crazy. I'll just 2 minutes here. I'll just let everybody know how I was forced to go to Bill Gates's house. That's what we used to say in 2020 because the YouTube algorithm would just throttle your account if you said any of those trigger words. But yeah, I just happened to be visiting my mom, who still lives in Canada, at the time that the pandemic struck. I think I went back in February. And when I went back, it hadn't really started yet, right? There was masks on the airplane, but that was kind of a remnant of just the fact that Taiwan, people regularly wear masks on airplanes anyway, even if there's no pandemic. 2019, people in Taiwan, in Asia, it's just a very normal thing to see people wearing masks. If you're sick at all, if you've got the sniffles, right, people are wearing masks. So I didn't really think much of it. I went back to Canada, and then wouldn't you know it, the whole thing blows up, and I'm stuck there, right? They close the border, they close everything down. And at the time, I'm not a Canadian resident, but I'm a resident of Panama, right? At that time, I wasn't a Dubai resident. I was a Panama resident. And again, it's a zero tax. It's a territorial tax system. So they actually do have full taxes. But unless your income is actually produced locally, then you don't pay any taxes. So I was tax-free living in Panama for basically a couple weeks a year, right? That's all you really have to do is just flash your passport. And it's called the Friendly Nations visa. I don't know if it's still available, but totally legal on the up and up. But anyway, time's ticking, looking at my watch, Canada's closed the borders. I'm looking at Panama. I've got to get back to Panama within this amount of time. And if I don't, I'm going to become a default Canadian resident again, right? Because that's how it works. If I lose my residency in Panama and I stay in Canada too long, well, now what? Now I'm a Canadian resident again. And I'm not going to tell you how much money I make, but I would have to pay the government an awful lot of money in taxes. And they got me. So they got me boxed into a situation where I'm not young. I'm be 50 next year, but I'm very healthy. I work out a lot. I didn't need the stick, as you said. But I just had to do a cost-benefit analysis. Do I want to avoid doing this and become Canadian again, knowing what our government is doing to people? Or do I want to just say, well, I'm healthy, I exercise, I eat right, probably nothing happens. I'm just going to take the stupid thing and then get out of the country. And that's what I did. I took my double shot. In Canada, I don't know how it worked for most countries, but your name goes on a list and they email you. And so as soon as my name came up, that day I was in there with my shot, and the very next day I was on an airplane out of there. And I haven't been back to Canada since, I don't know, I want to say July 2020 or something. So it's almost 5 years. Crazy how time flies. But my mom still lives there. My sister and her husband still live there, but I have not been back. And so what we've been doing recently, because of course, I want to see my mom, I've just been bringing her out of Canada and just taking her on really long extended vacations. So we went to Switzerland for a really long time. We did all the trains and, I think we were there for 5 weeks, 6 weeks or something. And we just came back recently, a couple months ago. We went to Amsterdam for a week. We did a 3-week cruise in Norway, and we came back to Amsterdam for a few days. We went to Belgium for a few days. Just got to see my mom, but also have to stay out of this ridiculous country called Canada. So tricky situation. They did get me. It was just bad timing, and there's just no way I'm giving any money to Justin Trudeau. So there you go. Did what I had to do and got out of there. Poor Canada, because what a beautiful place. I lived right downtown Vancouver, right on the ocean, right on Stanley Park. It's called Cole Harbour for anybody who's been there. It's beautiful. It's amazing. Vancouver is just a beautiful place to live, but the politics, it's not what it used to be, and the draconian governments. It's a real shame what they're doing to that place. Anyway, in Dubai, rumors with investment, $30 million possible to get passport. I've heard that there are levels you can go, but this is just light years above my level. I'm not rich enough to be buying passports, not even close. But I've heard that there might be ways to do it, but also that's probably just internet chatter. I suspect, as far as I've been told, it's zero. And it's zero for life. There's no most countries, 7 years, you can do it. Some as quick as 5. Some you can just invest a bunch of capital. Like small countries, they have programs where you can just buy a passport. You just deposit $600,000 in a bank account and they'll give you residency and a passport. But I think Dubai's very close to never for almost anybody, no matter how rich you are. The reason it's one of my short vol strategies is because my own barometer kept me out of the market in 2022. That's helpful. Mine kind of did, kind of didn't. It was a poor year. But the signal for short VXX was triggered since they're not operating on the same signals. That's good. Diversification across signal, strategy, asset class, all good stuff. Not a rent. I'm obviously a sub-tier service and use it to improve my own models and portfolio management. Yeah, again, getting back to it, I think I probably read a little bit too much into that first comment you made about how you can just hold a constant 10, because you've had 5 or 6 comments since then that quite clearly you're employing some much more advanced systems than that. So I probably lingered a little bit too long on a little bit of the semantics there. But bottom line is, there are so many very easy ways to bump that return up by simply being willing to exit to the sidelines. Sounds like you know how to do that. So any other time that volatility has performed like this August, I mean the roller coaster. I made 5,000 on UVXY and give it back the very next day. Yep. Join the club. I didn't make and lose, but what happened for us is my signals picked it up perfectly and we exited to safety and we were golden there for like a week and a half. We were making money. And then all of a sudden the market completely recovers back to the same spot in like 3 days. And I'm looking like far less of a rock star, unfortunately. But there will be a time when I nail it perfectly and people understand, that's why that VTS guy does what he does. So someday I will be vindicated, but anyway, any other time? I mean, back-to-back days, I know August 21st, August 24th, 2015, those were back-to-back VIX spikes of, I think, 44 and 45%, something like that. I can actually, again, what am I doing? I've got a spreadsheet right here. I'm sure I've got something that would show that really quickly on the fly. Come on, where are you? These things get too large. Scrolling down, 2015, August 24th, August 21st. So 46 and then 45 back-to-back in 2015. Now, the difference is, of course, that was the China hard landing scare, and the market didn't just whipsaw recover like it did this time around. That didn't happen. February 5th was obviously a monster year. That was Volpocalypse, or monster trading day. February 6th was down huge, but it took weeks to get back to the same spot. That was crazy. I don't know what was more impressive, the spike up or the vol crush after. I can't figure out which one was more extreme, but it was pretty crazy. Jim Simons has 30%-ish CAGR. The thing you have to remember about that is, though, it's a completely closed fund. It's 1 in a million. It's the only one of its kind. And yes, it's true that there have been reports of something in the neighborhood of that, minus a gazillion percent performance fees. I think it's like 30% performance fee or something. But yes, one of a kind, somebody has made over 30. But there, as far as I know, there's nobody who has a track record longer than, say, 15 years that is over 30%. Like you talk about Warren Buffett, there was a time certainly in the 70s and 80s when it looked extremely impressive, but you got to remember that interest rates were also very high back then. But, long term, it's like 22, 23, something like that. You've got other people like, I don't know, I don't know. But it's basically unheard of to have 30% for, decade or longer. So true-ish. You've got one example of something that was just bizarrely effective on large amounts of capital, which makes a difference as well. But let's not use that super extreme one in the world fund as the outlier for, a rule. No, it's make your own fund, invest from the U.S. account, and manage these funds abroad. This is legal way to prevent it. I wouldn't want to speak on that. I am not an expert. But tax residency is basically always dependent on where you live. That's what tax residency is. So there's nothing stopping an American from opening companies abroad and from opening multiple bank accounts in multiple different countries. You can just get on an airplane and fly to Georgia and go to Tbilisi and open a bank account. It'll take you 2 hours, and you'll have a new bank account in a foreign country. You could then take a plane from there, and you could fly to Italy, and you could open a company or go to Portugal, and you could do this. And they could even be legitimate companies and legitimate bank accounts. But all that matters with tax residency is, where do you live? Like, where can they establish that you are a resident of? That's where you're paying your taxes. And so in the U.S., unless you're also living overseas, you won't even qualify for the minimum foreign exemption. If you're living in the U.S. and doing this is the idea that people think, and I'm not hacking on you, maybe you know something I don't, but these people who say, well, all you have to do is just open an account in the Cayman Islands and all of a sudden you don't have to pay taxes. No, because you're living in New York. Of course you pay where you live, right? It doesn't matter where your company's registered. It doesn't matter where your bank account is. It matters where you live. And certainly in the U.S., they are very strict on that kind of thing. Even if you claim that you live overseas, it's still difficult to prove that you live overseas because, if you have property in the U.S., but you don't live in the U.S., that can be deemed your residence just because of the property. If you have dependent children under the age of 18, even if you live overseas and your dependent children live in the U.S., maybe you got divorced and you lost custody and you go somewhere else, you're still an American from the IRS's perspective. So you might be right, but I would be super, super hesitant to even think that you can avoid taxes. Really, the only effective way for an American to avoid taxes is Puerto Rico. That's really your best bet. So look into that if you're willing to live somewhere else. But yeah. U.S. already taxes worldwide income. I think I opened up a whole can of worms here. People are super interested in this foreign stuff, and you should be, right? I don't force it down everybody. I'm not like evangelical with it or whatever. I'm not like, forcing people to do this. It's just, if you watch, the saying that, I had his name just a few minutes ago, Andrew Henderson. The thing that his channel, he's got a catch slogan on his channel. He says, go where you're treated best. I like that. I like the fact that this isn't 1980. You don't have to live in the country you were born. You can shop around. You can go look to see who's got the better education, who's got the better schools. Do you want your kids to go to school in San Francisco, or do you want your kids to go to school in Shanghai or Dubai or Abu Dhabi or something? Do you want to live in Michigan, in that cold weather, or do you want to live on white sandy beaches somewhere else? Does safety matter to you? Do you like the feeling of knowing that it's been dark for 4 hours, my wife's still not home? Like, do I have to worry? Do I have to go get the car and go pick her up? Or is she okay just grabbing a cab on the way home? There's countries that I wouldn't, like in Canada, sounds stupid, but Vancouver is a dangerous place, especially for my wife, who's, she's very rarely outside of Taiwan. She maybe not be super street smart. I had a curfew for her. If it's dark, I have to be with you. That's it. That's the rule. Like, you can't be out at night without me, because you might walk into a situation where you weren't even aware of your surroundings, and all of a sudden you're in something that you didn't even know. So yeah, she had a curfew. Is it worth being in a country that you don't have a curfew for your wife or your kids? Shop around, go where you're treated best. Just because you were born somewhere doesn't mean you have to live there forever. So keeping all that in mind, I'm not trying to twist anybody's arm. It's just, it works for me. Again, like I said, I played pro golf for many years. I traveled around the world to many different countries. I played the Canadian tour. I played in the U.S., played in the Asian tour. For me, travel was a part of my life. So maybe it's easier for me. Plus, I have a business that's 100% online. Easier said than done for a lot of people, but works great for me. Okay. Why is IYR, what's my cat doing out there? Just bouncing off the walls. Why is IYR considered a defensive position? It has a high correlation with the S&P. So good point. Excellent point. Is my cat coming in, or is that my wife comes home? I don't know. Somebody's making noise out there. So the gold position here, this is basically a staple. Right? We wouldn't have any reason to change this. XLU is amazing. It's the best defensive position there is. So this one's always there as well. With the strategic tail risk strategy, this position is variable. So there have been times from 2012, actually this strategy launched in about 2015, but from 2015 to 2020, we had no problem using TLT treasuries, 20-year U.S. treasuries. Then we went to cash for a while. We're back into the IYR now because interest rates are probably going to be at least staying stable, but probably coming down. So IYR is something that always moves a little bit with influence for the interest rates. So if the Fed is raising rates, of course, you don't want to be in treasuries for safety. That's not going to provide safety. We saw TLTs down 50%. And IYR is not a safety position either. So you see it now, but a year ago, this was cash. This was not IYR. We have just done this recently. And essentially, it's a variable position. It's just for the current market right now, given what the Fed is likely going to be doing, IYR is a decent safety position. And it's certainly way better than the S&P 500. I can show statistics directly showing that SPY in that 60 to 95% vol range is way worse than IYR real estate. Even though on a long-term buy and hold basis, IYR is worse than the SPY, and drawdowns are even higher. I think IYR had a 70 or something drawdown, worse than the stock market. But in the times that we personally use it in the strategy, it's far better. I'm not concerned with buy and hold performance of anything I hold. I'm only concerned with the performance that matches up when I am most likely going to be holding these positions. I don't care that gold is a terrible asset long-term buy and hold, which it is. It's awful. I only care that in elevated volatility, mid to high, gold is a really good position. That's all I care about. I don't care that the VIXM is diabolically down almost every single month of every single year. I only care that when I'm going to be holding it, it's going to be going up. That's all I care about. So that kind of answers your question. IYR, I get it. It doesn't seem like the best thing in the world, but for our purposes, it's quite good. Okay. Let's get through this. Not that I'm not having fun. I like answering questions. Again, I hope I don't sound like I'm telling people what to do or preaching, like I'm levitating above everybody and like teaching. I'm just providing some color to what I do, and I've been at this for, like I said, basically 20 years now. I've learned a lot of lessons. So there we go. What are your thoughts on holding long-term SVOL and ZIVB for the dividends? Terrible. You know me. Is this your first time here? I think this is your first time visiting. because I've talked about that several times. Dividends are stupid. Can we just be honest here? I don't know why people think they're making money with dividends. Dividends come directly out of the stock price. I hope everybody knows that. I hope everybody knows that when SVOL pays you a dividend, they're paying it directly out of your pocket, right? If you're holding SVOL shares and you have $100,000 of value today in SVOL, however many shares that corresponds with, and then tomorrow they pay you a dividend that looks amazing on paper. They pay you that dividend. All that happens is you have additional cash and you have portfolio value that drops like a rock. And wouldn't you know it, it drops to the same level. So you still, the next day after getting your dividend, you still have the same amount of money. You didn't make any money. So the idea that you should hold something because it pays a dividend is pointless. The only reason you would ever use the dividend for any influence at all is if for some reason you needed the dividend, which even then I would call into question. Some people might say, well, no, that's great for retired people. They can just, yes, we get it that it's a net zero transaction, right? You're just trading cash for stock. That's all that's happening when you get a dividend. But maybe that person wants an income stream, so they spend the dividends. Well, if that's the case, you're way better off holding a non-dividend paying stock and selling it strategically when you choose to sell it. That's going to be far more tax efficient, and you're going to make far more money doing that. So there is no circumstance where dividend investing makes sense. It just doesn't exist. I get it. There's 30 million people in the world that are screaming at me right now, telling me I'm an idiot and I don't know what I'm talking about. Dividend investing is a massive thing. Like, people love it. It makes no sense to me. So when you look at something, when you look at a long-term chart of SVOL, people wonder, why does it look so different than something like SVXY? Like, SVXY is making all this money and somebody who holds SVOL is down big, right? Well, why? Well, it's because the dividend gets pulled out of the stock price whenever there's a dividend being paid. So what is the point? I just don't get it. I know I'm being super harsh on you, but this dividend stuff, there's so many people online that talk about dividends like it's a great thing. Sometimes I wonder whether they know where that money's coming from. Like, it's just the retained earnings of the company, it's being paid out by you. You're taking money out of your right pocket and putting it in your left pocket and thinking that you made money. That's what's actually happening when you get a dividend. I would much rather the company just keeps the money and spends it on something better, spends it on buying back their own shares. That's more tax efficient, because when you get paid a dividend, of course, you get taxed on that. I'd rather they just keep it in the company and just not pay the dividend and just make my portfolio value go up faster. I'd prefer that. I'd prefer they used it on R&D in their own company to maybe come up with some new products and actually accelerate their stock price. I'd rather they use that money to buy out a couple of their competitors and gain a competitive advantage in the market. There's so many better ways than just taking money out of one pocket and putting it in the other. But there you go. I came down harsh on power crypto here. Sorry about that. That was aggressive. But no, you would absolutely never, ever hold SVOL or ZIVB because of the dividend. The dividend is a non-factor. In fact, it's a negative drag on the thing. The reason you would never use SVOL, and I'll make a video on it, it's going to be in our volatility stuff. I'll probably get to what is VXX, what is UVXY a little quicker than SVOL. But it's just not a very good product. It's just structured poorly. It's very weak. It's about a 0.25 leverage factor, so it's weak. They have a hedging component that is largely useless. Like, they're just basically spending money on nothing, because very, very rarely would you need that anyway. I mean, maybe if you were buying holding, it might save a few dollars, but the accumulative loss of hedging is going to be far more expensive long term than the occasional gain from when the market crashes. Plus, like I said, it doesn't take a genius to know that you can just cycle out into safety very easily with low-hanging fruit metrics, and who cares about the stupid hedging at SVOL that only really kicks in on the extreme of the extreme. So yeah, it's just a poorly structured product. Plus, it's managed by other people, and there's always a little bit of gray area. The prospectus, I'm sure, makes it sound really cool, but I mean, who knows if it trades that way? A lot of those dynamic products sound way better on paper than the actual performance plays out in live trading. So, God, I could talk all day about how SVOL should just be off your list. There's, no offense to the people that manage it. I know it's like $1 billion fund or something. Can't imagine why there's a single dollar in it, to be honest. But there you go. Some people like it. Just know what, I mean, again, it's the same thing. I'm not telling anybody to do or not to do anything. I'm just saying that be aware of what you're doing. You're holding something that's a poorly structured product, very watered down, very waste of money hedges, and they're paying a dividend that you're going to be taxed on at a time then you probably don't even need the dividend in the first place, and that dividend comes straight out of the stock price, and the stock price drops, and your value of the stock goes down, and you are net zero the day after a dividend. So all in all, it adds up to what's the point? Any thoughts on venture capital and exotic assets mutual funds? Can't take these positions by myself. Problem right there. Now, you can see some rough numbers. There's never anywhere that you can actually get track records, but, they say that the performance can be better in some of those things. But they're only available to a select targeted audience of high net worth people and certain structures and whatnot. So for us regular retail people, I'd say it's just off the table. Is it possible Tiger wins another major? I mean, it's always possible, but it's extremely unlikely. When he won the Masters in 2019, that in itself was just insanely unlikely. I know it doesn't seem like it. A lot of people don't understand, but golf is a physical game, whether people want to acknowledge it or not. It is a young man's sport, and it is very, very rare for people of that age to be winning majors. Like Tiger's my age. Tiger's going to be 50 soon. I think he's a little younger than me, but not much younger than me. It would be just a staggering achievement. His 2019 win was, in my opinion, one of the greatest sports, if you call golf a sport, some people don't, one of the greatest achievements in sports history. Just the highly unlikely nature of coming back from such devastation to actually win a major. Crazy stuff, right? Damn near won the FedEx Cup. I couldn't believe it. But no, Tiger's not going to win another major. Tiger's never going to win a tournament again. Breaks my heart. I'm a huge Tiger fan. But he's done. He's aged out. He aged out years ago. The only reason he won a little bit later in his career was just because he was so much better than everybody else that it was still mathematically possible. But right now, if you imagine like a Venn diagram of all of Tiger's potential scores, and then you overlap that with the standard field of golf when you're playing against, Scheffler and, all these guys, John Rahm and Brooks Koepka, you overlap. In 2019, there was a sliver of an overlap of that Venn diagram. Right now, there's absolutely zero overlap. Tiger's best 4 rounds will not beat the field anymore. There's no overlap, right? It's just, he's done. The only question is, how many times does he play? Can we just appreciate the greatness and just watch him? I hope he plays forever as long as he can physically do it. I don't care if he misses every cut. I just love Tiger, love greatness, respect. I respect all the greats, and it would be a shame if we didn't see him play more. Okay. Been meaning to ask, how often do you update the VIX spreadsheet on the website? Quarterly. Yeah, I'll update it at the end of this month. Good call. I might have forgotten if you didn't bring it up. Yeah, quarterly. And the goal was to add a few elements each time I do an update. So I think there's something new on there already, and we'll see. I'll highlight it in a couple of weeks, but maybe I'll add something cool. Canada's dangerous? Yes. Downtown Vancouver is not what it used to be. Was thinking fiscal pressure. Bears and rainbow triads was the only bad thing. Don't care about cold. Welding keeps me warm. Welding, good skill. High-paying job. Vancouver's not cold. Vancouver's probably the nicest weather in Canada by far. I run year-round, golf year-round. It's barely, occasionally it dips below zero, but it's barely. It's not the weather. The weather's beautiful. People say, oh, it rains every day. No, it doesn't. It's perfectly nice weather. But yeah, it's not as bad as San Francisco, but picture like San Francisco light. It's not great. Portland light, not good. Wokeness is killing. And I'm a compassionate Canadian. I'm all for spreading out the wealth and, cracking down on wealth inequality, all that stuff. But at some point, you have to start prosecuting crimes. Like a crime is a crime. And I have all the sympathy in the world for people who break the law. Like I'm not one of those people who want to punish anybody, right? Like there's reasons people turn into criminals, right? And it's in many cases, it might not even be any fault of their own. We're all like, nebulous brains in our young age, and our environment influences us to the point where sometimes people get treated really shitty by really terrible parents, and they grow up in terrible neighborhoods and they just become criminals. But at the end of the day, we still have to separate those people from the rest of us. Like I can have all the sympathy in the world for somebody who breaks the law, but you still got to go to jail, right? So that's the problem with this new culture, is that we seem to have forgotten that you're not really helping anybody by allowing these cities to just crumble, right? You're not helping the people who live there. Obviously, their life is severely affected. And shouldn't you value the law-abiding citizens a little higher than maybe, sounds like a decent idea. But you're also not helping the people who are living in the tent cities. You're not helping them either. So I don't know. Seems obvious to me. You got to clean up these cities and do it in a compassionate way. And yes, we're going to give money, and yes, it comes out of tax dollars, but you're not helping anybody by allowing these. I mean, there's literally, I lived in, a very posh, rich neighborhood. Whatever, I know that sounds bad, but literally within steps of the gym that I went to, the 7-Eleven down the street, you'd see tents. You'd see people they just live there. They just live in front of a $3 million house, Crazy. Can't allow it. It's not helping anybody. So do it in a compassionate way, but do it. Society matters, and we have to have some law and order. I respect one of the reasons Dubai is pretty cool is that they do what's necessary to favor the people that, if you break the law, you're in big trouble. If you follow the law, there's opportunity everywhere. So not sure about his tax comments. Uncle Sam wants his cash, as Brent has U.S. passport. I do not have a U.S. passport. I'm Canadian. Do you invest all your money in the VTS portfolio, or do you have other investments? Very, very little. I have this house. I have, Dubai, but very little. 100% of my investable capital is in my strategies. Now, that is spread out. There are some option strategies that I do as well. The 4 VTS stuff that you see here, this is roughly 60% of my capital. My money is in the literal exact trades that our community is in. But then I also have what I would classify as the VTS options portfolio. And you've probably heard reference at some point to the VIX option strategy, the wheel of fun, the earnings trades, the directional flies, the volatility step, the calendar roll. These are all my strategies that are elsewhere. And I have capital in those as well. So I'm working hard behind the scenes to get it all released again. It used to be, largely available, but generally speaking, 100% of my money is in this. I'm not big in real estate. I don't do much else other than just this. You got to go where your competitive advantage is, right? I would imagine that if I bore down and I studied really hard and I spent a year or two at it, I could crush the real estate market as well, right? I'm a quantitative person. I have no problem working for 14 hours to figure something out in a day from morning till night and don't go to sleep until I solve this equation type of thing. I could crush real estate if I wanted to, but I just have not spent the appropriate time to do that. But what I have done is 2 decades of 12-hour days in the investment world trading volatility and options. So obviously, yes, I bought my wife a house, so that's kind of an investment. And yes, to save money in a place like Dubai, it makes more sense to own something. But it's, it'll be very modest, always modest homes. This home is like $900,000 or something, and Dubai's like 400,000 or something. I'm not a real estate guy. Could be, but I'm not. All my money's in VTS, basically. That's my competitive advantage. Okay. Does the market ever go up so fast that you sell into strength? It has happened. So one example that was interesting was during the Q4 2018 market crash, when the stock market eventually from October 5th or so down to Christmas Eve, the 24th of that year, it was down 20%. It literally V-bottomed on Christmas Eve. We were out of the market the day before that happened. And also for Volpocalypse, we were out of the market on January 29th. And of course, February 5th, February 2nd, the market got bad. It already dipped into negative backwardation in the VIX futures. And by the 5th, Volpocalypse. We were out before with what you would think was just me overriding the system, just basically saying, I'm out. I'm taking my cash off the table. It wasn't like that. The market was going up all the time. The volatility market was elevating slowly. I guess people were losing confidence. And we got kicked out into safety during a good period. And then 2 days later, 2 trading days later, epic disaster. So I looked like a genius, but it wasn't me making the call to move to safety. It was literally the volatility metrics kicked us out at the exact perfect time. It's happened 3 or 4 times. But for the most part, my style of investing, and pretty much everybody's style of investing, but my style, of course, you typically have to get kicked in the ass a little bit on your way out the door. To go from SVXY into gold, for example, it's unlikely to happen without taking a day or 2 of losses. Like I said, when we exited to safety, I'll tell you here, the market got really bad here, right? We exited on July 24th, which is this day. So we got kicked a little bit, and then we were loving this. I had no idea the market was going to do that. But anyway, here as well, we exited here, we got kicked for a day, and now we're out, and we've avoided, this mess here. But you typically, I'd say at least half the time, you got to get kicked a little bit on day 1 or 2, and then you move to safety. And then who cares? The market could drop out 30%, and I wouldn't care. But those first couple of days, you can sometimes. It's part of the territory. Like I said, trading small paper cuts for avoiding a 50% drawdown is a trade I'll take every time. So just sometimes you can't see it until after it happens. And recessions. The average recession, 6 or 7 years. So it might take a while before you realize tactical investing works, and it works well. Just you got to wait a little while to really feel it. Okay. A few off topic, but it's the end of the stream, so here we go. Will the Live tournament take over golf? No, it's shit. But the Saudis will take over golf. When you've got that much money to throw around, they're already doing it in boxing. They're already trying to do it in the UFC. I suspect, I'm a huge UFC fan, of course. Not really a golf fan, which is weird because I'm a pro golfer. But no, the product is just not great overall. But they've certainly taken a large chunk of the world's best players to a different tour. So that's something. And then the Live people and the Saudis basically pressured the PGA to partner up with them, so that's something. I guess you could technically say Live already won because they forced the PGA to do everything basically that they wanted them to do. So the Saudis and the Live people, they won big time. But golf will resume back to its normal within a few years. I think the Live will phase out and the tour will be back to normal with now 1/3 ownership of the Saudis, something like that. It's illegal to be poor in Dubai. I don't know about that. There's 90% expats in Dubai, and the largest percentage of them are from India, I suppose, India, Pakistan, Northern Africa. There's a lot of that. The working class, as you would say. Some people might be tempted to use the word, I don't know if I can use that word on YouTube, the forcing people to work against their will word, if you know what I mean. But I think the salaries are better in Dubai than it is in their home country. Certainly the lifestyle is better in Dubai, so they can actually work and make It's not money that I would work for in 40-degree weather, but people choose to do it because it's better and they can send money home to their families. So I think it's all good. I don't think it's illegal to be poor, but there are a few times when you're in Dubai and you feel poor because, I mean, it is just, you see extravagant wealth that it just doesn't make sense, sometimes. But you don't have to participate. Dubai is actually a very cheap place to live. If you want to live a normal life, it's actually cheaper to live in Dubai. People think, oh my God, you have to be a millionaire to live there. No, rent is cheaper. Houses are way cheaper. Cars are cheaper. Gas is cheaper. Food is okay, normal. You don't have to eat 5-star restaurants. You can live in Dubai with a very reasonable budget, lower than you could live in London for sure, lower than you could live in Vancouver. I mean, like my house it's like $400,000 and it's nice. I used to live in Cole Harbour. It was $2 million for the apartment that I was in. And it was a two bedroom, two bathroom apartment. Beautiful view, of course, but $2 million. That exact same apartment on the water in Dubai on another white sandy beach, it's like a third or a quarter the price. So yeah, unless you really want to live that 6-star lifestyle, you don't have to. Like, I don't participate in that. I'm a very simple person. My wife, not so much, but I'm a very simple minimalist person. So I feel it, but I'm not tempted. I don't care to impress people. I'm just me. But there are people who go broke in Dubai trying to keep up with everybody else. Big mistake. You can't keep up with these people. They have so much money, it's ridiculous. You see crazy stuff. Like, you'll just look over and there's a guy in a Rolls Royce with a tiger hanging out the window. You're like, what is going on? Here in my country, dividends are forced, 30% of profits at least. Slow blue chip market, but there's a lot of arbitrage opportunities available. That would be interesting. Dividend harvesting strategies, because of course, it's not a straight one-to-one. The dividend comes out of the stock price, but if you are effective at analyzing the news cycles and the cycles of dividends, there are certain stocks that tend to, even though they should just completely balance out, and on balance, the vast majority of the market does balance out because dividends are literally mandated coming directly out of your pocket. But there are some stocks that after the dividend is paid, there's a little bit of residual benefit there. It can happen for some really good quality stocks. So I'm not saying it's 100% useless, but it's a whole rabbit hole. You go down, you might make an extra 5%. It's not worth the effort. Learn options, learn volatility. You will think dividend investing is the dumbest thing in the world. Once you know how to make 10 to 15% a year trading options, why in the world would anybody focus on anything else, right? So again, it's one of those things like the don't short naked calls on UVXY. I'm not saying you won't make a positive return. I'm just saying don't waste your time. There's far better ways to do it. It's the same as dividend investing. I'm not telling you you'll lose money. I'm just saying there are far better places to spend your financial capital, your emotional capital, your hours that you're spending trading. There's just better things to do with your time and money. Don't do it. Could you critique SVOL performance on after August 5th? I mean, the critique is it's a poorly structured volatility ETF that I wouldn't touch, but $1 billion worth of other people's money seems to be disagreeing with me. You are not worried about World War III. It's coming. Not worried. I'm not worried about anything. What does worry do for us? Am I conscious of the fact that the world in some areas seems to be heading in a bad direction? Yes, I'm conscious of that. I'm not blind to the world this is just not the world we were in 5-10 years ago. I think social media has an awful lot to do with that. I'm of the age, I'm an old man. I remember the before times, before social media. I remember living in college. I didn't have a cell phone. So yeah, I'm right in that generation. Like, I'm Gen X. I lived before and after social media, and social media is crippling our societies. So, you're not wrong. I just wouldn't use the word worry. I don't worry about anything. I just take care of myself and the people around me, and I work my ass off to make sure that certain things, when they happen, that they don't catch me off guard and that they don't negatively affect me. The one thing that you will learn, of course, this is probably not necessary to say to my style of community. We do have all men here, and we do have men who are successful and learning how to invest and worrying about their futures and stuff. Not worrying, I shouldn't have used that word. But no one's coming to save us. Like, men know that we are in this by ourselves and we have to do it. So am I worried about World War III? No, because I've structured my life and I'm a workaholic, and I've built up skills that I'm going to be able to handle anything that comes. If there's World War III, I'm not getting caught out in it. I'm a pretty passive person. I'm certainly not picking up can I say gun? Yeah. I'm not going to pick up a gun and defend my country's flag. I'm not that type of person. If I don't believe in what's going on, I'm out, guys. Good luck, you do you, but I'm just going to take all the people I care about and leave. Yeah, I would say I'm optimistic about the world. I'm more optimistic about the world that I can sort of control myself into, because even if the world starts to fall apart, I can still stay ahead of it because I've planned my life that way. And, you want to be anti-fragile and all these good things. If it happens, it would not surprise me, honestly. We are dangerously close, and we are at each other's throats constantly. And, politics is a national sport. And if you're on the blue team and that guy's on the red team, then I guess you're mortal enemies. And, crazy stuff. Social media. Remember back in the day where you had no idea the political opinions of anybody around you? Remember what that felt like, to not know that dude at my office is a Republican? Like, it didn't come up. It wasn't a thing back then. We didn't care. I have no idea what the political leanings of my friend in college. Like, we're smart guys. We're educated people. We're not sitting around debating whether, price gouging is communism and this guy is a Nazism, and like, this just wasn't a thing. So I mentioned VIX as a garbage indicator. Could you please elaborate? Sure. Do I have the right spreadsheet out? Sure, I can elaborate. That's not the right spreadsheet. Give me a second. You'll find this interesting. Maybe I'll answer another question while I'm doing this. Or what spreadsheet is it? Yeah, it's that one. Give it about 5 seconds to load. My spreadsheet's crashed my computer, but yeah, absolutely. I can explain visually why the VIX is terrible. It's because it's a very narrow indicator, for one thing. It's only derived based on S&P 500 options, and that's not a huge chunk of the investing world to begin with. So you're obviously going to be missing some important stuff, but it's also structured in a way that it's taking too high priority on something that people typically use for, in many cases, are using for hedging against a long stock portfolio, right? It would be a bad assumption to think that those S&P options that are going through are actually directional plays, right? So the VIX can actually be wildly incorrect at different times. So what did I want to show? I know there was something. What I wanted to show is this is a very basic example of buy and hold on the S&P 500, right, since 2011. All right, so entirely bull market, the rate of return is going to be slightly higher. And then I'm dividing it up to short volatility, short the VXX during the 50% lowest volatility readings, and be in cash the highest 50% volatility readings. And then do the same thing on the VIX index. Short volatility, short VXX during 50% of the best VIX signals, and cash during the worst ones. Here's the results. So the S&P 500 long-term since 2011, again, all bull market, so it's going to look a little higher. It's probably closer to 9, but 12.6, not bad since 2011. Short VXX using the VIX, 3, with a maximum drawdown of 62. And then, of course, this is a chart showing the effectiveness of my indicator, just a dirt simple 50th percentile line. Like this is not even me filtering for the good trades. This is just 50 in, 50 out, as simple as it possibly gets. Short VXX, 28% annual with a 37% drawdown. So it's like, 2.5 times better than the SPY with roughly the same drawdown. You can see, and again, this is not cherry picked at all. This is not optimized at all. Of course, we can do better than this, but this is just 50-50. But look at the VIX. Like using the VIX, it's just hit and miss. This is exactly why. There are times when the VIX looks like it's a crystal ball. You just follow the VIX. It's the easiest thing in the world. And there are other times when the VIX just gets you going absolutely the wrong direction. So long term, it sucks. It's a terrible indicator. The VIX is only good when you combine it with other metrics. Like the VIX futures by themselves, not that useful. The VIX index by itself, pretty useless. The VIX futures to the VIX index ratio, extremely important. So when you use them both together, now you're onto something. Either one of them on their own is just hit and miss. You could be 180 degrees the wrong way some of the time. So that's why. Somebody disagrees with me. I like it. I do not agree with you saying VIX structure is not important, but VIX cash for ETP decay. In my view, VIX cash is irrelevant until the moment when VIX future expires. Well, no, because it's a constant 30-day maturity VIX future. So every single day with volatility products is equally important as the previous days. They're all the exact same weighting. The volatility ETPs roll their futures from M1 to M2 in equal fractional amounts every single day. So it doesn't matter if you are on September 6th, like today, or September 17th, or September 29th. It is the exact same weightings. Now, it'll be different, M1, M2, but that constant 30-day window is just constantly being rolled forward. So there is no, it gets more important as you approach expiration. It's literally identically important every single individual day. And all that matters is the VIX futures in relation to the VIX index. That's it. So I get what you're saying, and this is a common misconception that because the VIX futures roll forward and expire to expiration, that's the important day. But you have to remember that on that day, 0% of the VXX is being held inside 30 days. It's 100% already been transferred to M2 30 days out. So the rollover means nothing. There's no capital in that rollover future. It's all gone by that point. So you start with 0% back month, 100% front month, and every day it's equal fractional amounts getting pushed forward. So every single day has the exact same importance as the previous days. So, yeah, nice way of saying no. They're all the same. Every day is the same. We should wrap this up. My God. Oh, and my wife agrees. There you go. It's time to sleep. What is it? 2 o'clock in the morning. Because I'm in Taiwan right now. It's 2 o'clock in the morning. My wife is correct, right? As I'm supposed to always say out loud to her every single day. No, I'm just kidding. Everybody knows I'm always right. Okay, I'm going to wrap this up. So thanks, everybody. It was a very long live stream, but in fairness, we haven't done one in a couple weeks, so no problem. We'll be back next week. I will have a couple good topics. Obviously, hit the like button on your way out. Subscribe if you haven't. Like 60% of people who watch my videos are not subscribed, so subscribe to the channel, and I will think about some good topics for next week. See ya.